Hello, this is Dr. Oz. Today, I would like to talk about Markowitz portfolio model. And Markowitz portfolio model is based on risk versus return, which is mean versus variance. This is risk is measured based on mean versus variance in modern portfolio theory, which I may not quite agree with that, but this is very common practice in finance. Um, so the idea is that we will have target return, and based on that, we will try to minimize our risk. And so let's give an example here. Imagine an investment company, Hawk, um, and they design annuities, IRAs, 401k plans, and other investment vehicles. And this company would like to develop a portfolio model that can be used to determine an optimal portfolio mix for given return expectations. So these are the mutual funds that they are thinking that are maybe 5-star Morningstar ratings, and they are thinking, hey, how should we allocate our portfolio for our client who has, let's say, $1 million? Should I put most of it in foreign stock or intermediate bond or so on? To be able to decide that, of course, I need to have some kind of understanding of my customer. Let's say this consumer or customer wants to have 7% return annually on average. Let's say this is arithmetic error average. Normally, we in finance we talk about geometric returns or averages, but let's assume that this is the foundation's arithmetic average. All right, so let's build a model for this. I will start with my given parameters. So let's start with the mutual funds that I have. I have foreign stock, I have intermediate term bond, I have large cap growth, which these are the big corporations, multi-billion dollars, like Facebook, Google, Amazon. Those are the companies that are big and growth companies. Large cap value, these are huge companies, but not necessarily for appreciation. You are more on cash flow business, which I like it in terms of since I'm a value investor. And these could be Gillette or recently Kraft and Heinz or Bank of America, JP Morgan Chase, and so on. Small cap growth, these are smaller companies. I mean, maybe billion or 2 billion or a couple $1 billion growth companies. And small cap, again, value companies. All right, so these classifications, of course, do change based on the market, how big the companies are, but so large caps are multi-billion dollars, and small cap is a couple hundred million or low $1 billion or so. So let's say this client would like to have return of 7%. And let's say the portfolio client wants to spend all the money, doesn't want to have any cash. In some portfolios, we do have cash, but in this case, my client doesn't want it, so 100% invested. All right. So based on this given names, I would like to now work on my possible returns, right? Based on historical data, I forecast these scenarios for the future: year 1, year 2, year 3, year 4, year 5. And you do this in general by forecasting and using simulation to deal with the possible uncertainty in the market. And these are obviously not going to be 100%, but it's kind of an indication based on historical data. So let's say foreign stocks, these are percentages. I expect to get these returns, 10.06%. Let's increase decimals here. Year two, I expect 13.12%. Year three, 13.47%. Sounds like great returns, right? And then 45.42%, but I know that it can crash because foreign markets are in general much more volatile, 21.93%. Intermediate bonds are, as you remember, they're more risk averse. In today's market, it's impossible to get these returns, but in the past, maybe 1980s, we could get these returns of 16.64. Today's market, even if you invest in junk bonds, you won't get 16.64%, 3.25%, 7.51%, negative 1.33%, and 7.36%. Again, these are my forecasts, but they could be exact last 5 years, and assuming that last 5 years is going to be a great indicator of next 5 years. Okay, so now let's go to large cap growth, and I expect growth here, right? Good returns. 32.41, 18.71, 33.28, 41.46, and negative 23.26. All right, large cap value probably will have less fluctuation, possibly a little bit less return, not necessarily though. 32.36%, 20.61%, 12.93%, 7.06%, and let's say there's a crash again. Looks like in year 5 expected negative 5.37%, but I'm not crashing as bad as growth, as you see here. When the market goes up, though, I'm not enjoying that much necessarily. Our small cap growth, looks like everyone's going up in the first year, and small cap growth even increases higher. 19.4%, 3.85%, 58.68%, and losing negative 9.02%. And small cap value, 24.56%, 25.32%, negative 6.7%, 5.43%, 17.31%. All right. So now I can build my model. All right, let's build the model here based on these given things. First thing first, what's the objective of this model? It's basically minimize the risk, because not a maximize return problem, because risk return is fixed. At least I want to have 7%. But reaching this goal, I would like to have minimized the risk. And risk, I will measure it. You could measure it via variance. I don't like variance personally, so I will measure it in terms of standard deviation. All right, so let's do it here. And second question is, what are my decision variables in this problem? I'm basically trying to decide what percentage of money should go to each of these categories. All right, These are gonna be my yellow cells. For fun, I can start with random portfolio. Let's say I like to, I'm young, at least right now. I will take more risk. Let's say I want to put 20% on my portfolio here, maybe just 5% here. Let's put them as a percentage, by the way. Let's make them percent. All right, I want to put 20% here. Let's say I want to put 5% here. Growth is good. Let's say I put 10% here. Value, I want to put even more here. I'm a value investor for 20. Let's say I'm at 40, 55, 20 here. Or let's say 50, 10 here, 65, and I put, let's say 35 here. So now I'm a risk taker. So it looks like I got 100% this distribution, let's say. So now based on this, I would like to understand what's going on in my objective, which is minimize risk. Before measuring the objective though, I would like to introduce my constraints. Subject to. As you know, constraints have three components: left-hand side versus right-hand side. In general, right-hand side values are given, left-hand side values are calculated, and versus relationship. So I have basically two constraints that are given to me here in this from this client. Right-hand side value, I want to have at least 7% return, since it's at least greater than or equal to. And I want to spend all my money. So that right-hand side is 100% and everything, so equality. All right, so my required return, what return am I getting based on this combination? So that's what I need to figure out, right? So that's an important thing. So to be able to do that, I can do this, but by basically some product, this plus this, that. I just don't want to make complicated here. Let's create a timetable here to make things a little bit easier for me to see. So what am I gonna do? Let's put the years, copy, and then let's say paste them over here. Let me just give some more space here. All right, and I want to get the average of those five. So one thing I would like to keep track of is annual return. That's an important thing. Another thing is I want to know deviation from mean, and I would like to know deviation from mean squared. All right, so this is a variance measure. I'm trying to measure the distance between the annual performance versus mean, and this is my annual performance. All right, so now I'm ready to make some calculations. So my annual return year one will be some product of my portfolio mix times the corresponding returns. So year one, if I use this portfolio, I will get around 24.57%. Does it make sense? Let's take a look at it. Yeah, of course it makes sense, because I put some of my money into small cap, which gave me more money and large cap value, but also I put some foreign stock that didn't give me that much value, that much return. All right, I want to drag this right. To do that, I need to lock my decision variables, the blue ones in this case, F4, and I can drag it down. And you see my return 24, 19, 7, 22, and I lost 2%. I could have lost 21%, right, if I went all in with foreign stocks. So my average then, again, this arithmetic average, which I'm not super fan of it, but I'm just showing you, this is introduction video for a portfolio optimization considering risk, is 14.25%. Doesn't sound too bad to me. All right. All right, so what am I gonna do next? I would like to know the deviation from the mean. So this is my mean. Maybe I can color it a little bit differently. So my deviation from the mean is literally this minus this. Let me lock this average. I'm going to use it over and over again. So I deviated 10% from the mean in year 1. And year 2, 5%, year 3, negative 7%, and so on. And I don't want these negatives and positives cancel each other out. So that's why I will take square of that, power 2, so that positive and negative won't cancel each other out. Perfect. Now, if I add these up and take the average, it will give me average variance. If I take square root of that, that will give me standard deviation. So what I'm going to do is square root of sum over these deviations squared, divide by number of deviations. Let's say count. I have 5 of them here, but let me just count them. All right, so basically, my risk profile tells me that my deviation is 10.25%, which means higher the deviation, higher the risk, which is more volatile. Again, I'm completely against this idea as a value investor because I think you only lose money when you sell it. And you don't really care about stock price ups and downs like this. But some people may argue that, hey, you may need to sell your stock in year 4 and volatility can impact you. I don't buy that. I believe in saving some cash for a rainy day fund and sticking to your long-term perspective, 10, 20, 30 years, like Warren Buffett. All right, so now I can see here what return I got, average against arithmetic average, which I don't like. It's okay, it's a good indication right now. And the portfolio sum should be 100%. So my decision variables should here end up 100%. All right, so these are my constraints. I have 2 constraints, looks like here. So now I'm ready to solve this problem. Again, on the data tab, you should have solver. If you don't, file, options, add-ins, analysis toolpack, go. Make sure solver add-in is checked. Okay, it will take a minute or 2. Then on the data tab, you will see solver. My objective is the green cell, minimize the risk. I'm trying to minimize it. Decision variables are the yellow cells, these 6 cells. Let's add my constraints. I want my required return to be greater than or equal to 7% in this case, add. And I want to spend all my money. This left-hand side should be equal to this right-hand side. Click OK. Now I will use nonlinear programming. Why? Because my objective is square terms and square roots, and this is not a linear function. So I will solve this problem. I click OK. So it looks like I could enjoy 7% return, actually 8.44% return by only having the risk of 4.57%. Okay, well, this is the best portfolio that minimizes the risk for this client that will achieve the goal of at least 7%. How to do that? Invest 17% in foreign stocks, 72% in intermediate term bonds, and 11% in small cap. Okay, so let's say this was my 7% scenario. What if I want to have more returns than that? Control drag. Let's say if I want to get 10% return, I will just change this value to 10% and then solve this problem again. Data, solver, and then solve it again. And then you will see here that your risk will increase from 4% to 5%, and you get 10% return. Okay, how about if I increase my expectations? Another client comes and say, hey, I want to get 12% on average. All right, no problem. Let's do it. Solve. If I solve this problem, now looks like I forgot to type 12 here. 12%. So if I want to do that, solver solve. So this person is saying it's 6% risk standard deviation. All right. So what if I want to get 15% return on investment? Control drag 15. All right. Let's plug in 15 here. Run the model again. Okay, 8% risk. So more risk, more return, as you see. What if I want to get what if I want to get a 20% return? Data, solver, solve. All right, you gotta get 19% risk. Still, you can achieve that goal, but you gotta take more risk. How about if I want to get 25% return on average? Let's see what's gonna happen. And okay, oh, looks like I forgot to type here 25. Let's do 25 and try to solve it again. Oh, solver could not find a feasible solution. Looks like I cannot get 25%. The highest I can get is 21.27% by investing everything into small cap growth, but that will give me a higher risk. Okay, so this is the idea of high risk, high return. What if I want to get, let's say, only 3% return? If that's your goal, 4.57. So it looks like it didn't really change. So, okay, the lowest risk you can reach is 4.57, and you will get 8.44% based on this profile. I mean, you can get lower returns, I believe. Let me see. So what's the average values of these things? I'm just curious right now. 12 for. So these are the averages actually for these. Excuse me, investment options. So these are the averages. So as you see here, actually you can really go down 6.89%, but my portfolio is saying that, hey, why would I do that? Am I stupid? Excuse me, because even if I do that, I cannot decrease my risk. So I rather have 8.44% with minimum risk. So this is great tool for us to understand the optimization in terms of risk. That's it for today. Until next video, enjoy business analytics.